So Apple's next event is planned on September 12th, and they're gonna reveal the new iPhones and new AirPods, and there may be few surprises as well. So how do you benefit from this event using option strategy? That's what we are gonna discuss in this video. If you are interested, then please stick around and let's start. Hello guys, I'm Abhi and welcome to my YouTube channel. This is a fairly new channel and I would really appreciate if you do hit a like and subscribe. I make mostly option related videos. So let's start with the topic of today, which is the Apple event and how do we benefit from that event. So this strategy is called straddle, which is basically, as per the Investopedia, as you can see, this is a straddle is a option strategy which involves purchasing both a put and a call for the same strike price. So it's basically a strategy where you're gonna benefit for a large move. As you see, like for a event of this magnitude, you may expect a big move in a stock price. So Apple may significantly move down based on what happens in that event, or it may go up significantly based on what they announce, right? One assumption that this straddle strategy takes is the stock is not gonna be in a sideways movement. It will have a big movement either on the downside or on the upside. So that is the basic assumption for this strategy. Okay, we are going to discuss the profit and loss in detail later in this video, so you will exactly know why I am saying that a sideways movement is bad for this. So as you see in Investopedia, right, this is the graph of how a straddle strategy looks like, and as you can see that this has a unlimited potential on the both side, right? It has unlimited profit potential and your max loss is kind of capped here. So that is the advantage of this. There is another strategy as which is called a short straddle, which is just exactly a mirror image for this, but that is having a unlimited loss potential. So I would never recommend doing a short straddle. In case of long straddle, your downside, like it is capped to whatever you will pay the premium. We will go into an example to make it more clear. So for now, let's understand that you have a both upside and downside. In either cases you're gonna benefit unlimited. So if Apple goes really down, you have unlimited profit potential. If Apple goes really upward, you have unlimited profit potential. The only case where you're gonna lose is if after the event, if Apple stays as it is right now. So let's look at actual example, right? And I always prefer to go and use this options strat site, right? So this has a very good graph and you can visually see what your strategy is, and before getting into a strategy, you can clearly see your profit and loss graph, right? So let's try to build what we discussed. So what you can do is there's multiple things that you see here, right? There's all of the options strategies. So we are interested in doing a straddle, right? So we're gonna select straddle, and it is already like so the event, as you know, is on 12th September, right? So we can select expiry as 15th, and then we are gonna select a strike price. So in this case it has selected both already. It's showing, right, 190 strike price as a call, and then you sell a 190 a buy 190 at the same strike price, right? So this is the straddle. As you see the graph that you saw in Investopedia, right, this is the exactly the same graph that you see here. So it's kind of as you see, for these opening these two positions, the max loss is whatever you paid. So because you are buying a call, right, you pay an amount, and then you are buying a put. So for both of these, you are basically paying this $534, right? That is your net debit. So that is, and this is also your max loss, right? But on the max profit side, as you see, this says infinite, right? So you have a max profit which is uncapped. Now let's discuss the break even price, right? What is your break even price in this case? Okay, so as you can see clearly in this case, let me just Let me just shrink this graph little bit so it is more clear. Okay, so now as you can see, right, your break even on the downside is 184.66. Why is that? Because remember, you paid a debit of 534, right? So that's why you will have to subtract that $5 thing from your strike price. Your strike price is 190. You subtract your whatever you paid, right, and that gives you the break even price on the downside. Similarly, on the upside, your break even price is somewhere close to 195, right? Now your profit starts after the break even. So you are gonna profit from this strategy if after the event the Apple drops to 184, anything below 185, right? That's your profit zone on the downside. Or if Apple moves up and goes like beyond 195. So if let's say after the event Apple really shoots up, they announce something big and the Apple shoots up to $200, you are gonna profit really big on that case. So your profit you can actually see. Let's further zoom it out. So let's say it closes at 200, right? So at 200, if the Apple closes, you're gonna profit almost $464 in that case, right? So on the downside, usually after some big events like earnings or any kind of a big event, right, it generally happens that as we say, right, that buy the rumor and sell the news. So stock prices drop even though they announce something good, or even though the earnings are good, the stocks may drop, right? So let's say it drops to one, right now it's trading at 190 and it drops to 180, right? So in that case, you're gonna profit $430 even in that scenario. Now let's quickly discuss the downside, right? What is your loss zone? So you're gonna lose the complete $534 if nothing happens and Apple just stays right at 190 at your strike price after the event. That is the scenario where you're gonna lose the complete 534. And it also shows like as you move either on the upside or on the downside, you are gonna not lose the complete premium that you paid, but you're gonna lose some amount depending on where Apple ends up at your expiry on September 15th. Okay guys, so that's what I wanted to discuss quickly on this video, and my personal take would be that it is a good strategy because of that event. However, I would not say that you go too high on this because it is a I would categorize this as a high risk, high reward kind of a play. So go with a small amount as your the good thing as we discussed, right, with this strategy. The good part is your downside is capped, right? Your max loss is capped, but your upside you have a unlimited upside. So if you are really right, if the Apple makes a big move on either side, you're gonna profit big on this. So that was it for this video guys, and I'll talk to you in my next video. Happy investing.